Hi, I'm Brian. We need to discuss 6 high-yield ETFs that you can immediately purchase now and start earning income. First, if you don't mind, hit that like button. It helps push this video out to more people. And hit that subscribe button so you can get more of my videos. And I promise I'll reply to the comments and questions as soon as I can. Now, before we get into the ETFs themselves, what is an ETF? ETF stands for Exchange Traded Fund. So let's talk about 3 different things. You're familiar with stocks. You go on to your broker and you purchase your stock during trading hours, sometimes after trading hours. But basically, you'll watch that stock price go up and down during the day, and you'll put in the price maybe that you want to purchase, or you'll just purchase at market. What are you buying? You're buying one stock with your money. Then came along mutual funds. What are mutual funds? Mutual funds are essentially a way for you to diversify. So you may not have enough money to, let's say, buy 100 different companies. Or for example, you've probably heard of the S&P 500. It's made of 500 companies. So you might pick a mutual fund that invests in those 500 companies. Or maybe it just invests in companies that have to do with the energy sector or the pharmaceutical sector. And those are a way that you can purchase that one fund at a price, and you're essentially buying a share of the mutual fund. The mutual fund then does the work of purchasing all those individual stocks so that you can benefit from that diversification. So now, instead of owning one stock, and that one might go up or down, you now own a mutual fund or a share of the fund, and it has that money spread out among 10 stocks, 50, 100, 500, however it may be. And then that way, you're not going to have to worry as much about one individual stock performance because, of course, there's others. That's the idea of diversification. Now, mutual funds have been around for a while, and there's a fee involved because they're managing the funds. There's a group of people, or sometimes these days it's even computer done, but there's usually someone behind the scenes who's making sure that their criteria is being followed. And in that case, there'll be the yearly fee that they charge, and then you'll get potentially a yield, and you'll also get, in other words, you might make interest on the money that's in there. Some do, some don't. But what you'll get is potentially appreciation, meaning the fund price can go up or down just like a stock. However, it only trades at one price during the day. It doesn't trade like a stock where you can follow it up or down and trade at different prices during the day. So the ETFs were born with the idea that they wanted to get to the liquidity of a stock such that you could trade it throughout the day at whatever price the market's bearing at that point in time, but also have the benefit of a mutual fund such that it can invest in many different companies. And you've got that diversification. So you don't have the limitation of just trading at one price during the day. You can trade on the exchange just like a stock. Buy it and sell it throughout the day at any given price, and also have that diversification. So there's where ETFs were born. Now they do have a cost in terms of a maintenance fee, and they can invest in anything just like a mutual fund can. So let's get into the 6 that US News put out recently as their top 6 high-yielding funds. And I'll give you my opinion on all of them. I'm not a financial advisor. This is just my opinion. Take it as such. So here is what US News chose as their 6 high-yield ETFs. And I'll put a link to this article down below, but let's talk about each one. So first they've got what they call QYLD, Covered Call ETF. We'll get into that one. But look here on this chart. It's got how much of assets under management they have, the AUM, meaning how much are they managing in terms of how much money is in that fund. Also, it's got the trailing 12-month dividend yield. What was the dividend yield for the last 12 months? And then their expense ratio, which is what are you charged each year for their services to manage this fund. For full transparency, I happen to invest in QYLD myself. It is what's called a covered call fund, which is an option, and they do it every month so that they can obtain the best possible yield. Currently, I believe it's 12.4% yield, and it's on just the NASDAQ 100 stocks. They have been doing this for quite some time, and as you can see here, they have $7.9 billion under management, which is quite a bit of money. And they've been doing this, like I said, for a while. And they also pay out this dividend on a monthly basis. Next, they have iShares Mortgage Real Estate ETF. They talk about how if you're familiar with some of the real estate funds, they will purchase real estate, maybe in a particular market, meaning a particular area of the country, or maybe they only purchase real estate that has to do with, let's say, office versus warehouse or industrial, and they collect rents on those properties. That's not what this one does. This one actually holds the notes, or the mortgages, if you will, on those properties. Personally, at this point in time, I would not touch anything. This is January of 2024. That has to do with real estate, particularly commercial real estate, from what I've seen. And their assets under management are $636 million, which isn't a huge amount, decent, but not gigantic. So personally, at this point in time, I would invest in one of these real estate ETF high yield funds. Next is one by BlackRock, the floating rate loan, they call it. Now, this particular one, as you can see here, has only been around since October of 2022, and under management, assets under management, $21 million. Some people have positive views of BlackRock, some have negative views, some have neutral views. Not going to particularly get into my view of BlackRock at the moment, but as you can see, this fund having only been around for a year and only having 21 million assets under management, I'm really not sure why US News added this to the list. It doesn't really make sense to me. So personally, I would skip that one regardless of the yield, because this yield has only been for 12 months and they've only been in business for up to almost 2 years. Next is the Global X S&P 500 covered call. They call it XYLD. This is the same company that runs the QYLD. That was the NASDAQ 100 for the QYLD. And this is the S&P 500 for what they call the XYLD. They use the same strategy. And it's currently at a 10.9% 12-month trailing yield, and it's got about 3 billion assets under management. Next is the SPDR SPDR Bloomberg High Yield Bond ETF. Usually when people think of bonds, they think of a fairly stable and safe, secure investment. That's because there are what's called investment grade bonds. They grade them on a scale. This is what you would call a junk bond fund. So these bonds are not investment grade. Now they yield a decent return, 6.4%, not too much bigger than if you just went out and got a T-bill or a treasury bill. And they have 9 billion under management. I'm not a fan of junk bonds, so I'm not sure why this particular one made the list. And at 6.4%, that's not substantially greater than what you could just go get a treasury bill for. Let's move on to what they call the Amplify High Income ETF, YYY. This one's actually very interesting to me. Let's see here. Assets under management, they're at 400 million. Their rate of return is 12%. What I think is really interesting is because as we spoke, or as I talked earlier, an ETF or a mutual fund, the idea is diversification. They go out and they purchase all of the different stocks within the fund, within the ETF fund. And then, of course, you're just buying a share of that ETF. They do the diversification for you. So that's great. It's diversified. This is what I would call diversified squared or double diversified. Of course, it's different than big squared. But what they do is they are an ETF that actually buys other ETFs. So what they're doing is they're buying other income producing funds. So you might say to yourself, I don't know which ETF I should buy. Maybe I only have enough money and I only want to purchase one. So I'm not sure which one I should buy. Here's a list of 6. There's many lists out there. Different amounts of assets under management, different types of investments, different yields. They've been around for different amounts of time. What should I do? Well, here's one, and I think this is fascinating, where they said, you know what? We're going to go out and purchase not individual stocks, but a whole bunch of high yielding funds. And so when you buy a share of YYY, you're actually getting a piece of many different funds. So those funds diversified themselves, And then this fund invested in a bunch of those diversified. So if they each had 100 and there were 5 of them, you now have exposure to 500 of them. So this, I think, is actually a fascinating way of getting started in ETFs. And to get started in ETFs, I should say, all you need to do is go to whatever brokerage you may use online, take a look at these ticker symbols. I'll put a link to this article, and you can purchase them just like you would purchase a share of a stock. So take a look, because I think this is a very interesting point in time, being early 2024, where some of the prices of these, you'll note that, for example, QYLD, as most of these, or I should say all of these, you'll see that their price, and you can look at their price action over the last month, 3 months, a year, 5 years, and you can see how they've changed in price. And quite a bit of these are down in the price of the fund, and they're yielding decent yields. And so you possibly may make some appreciation in the future on the price of the fund itself, not just making a decent high yield. So if you want to get involved in high yielding ETFs, it's very easy to do. Go to your broker, log in, purchase them just like you would a stock. I hope these high yield funds can get you on the way of producing some passive income for yourself. You purchase a share, you do nothing, and you get a yield in your account every month, just like you would get from a checking account at a bank. But 12% is substantially more than what you're going to probably be earning at your local bank. So thanks for watching, and I hope this has helped.